is at war. Not just on borders, on markets, on currencies, on the future itself. And the retail investor has no idea.
This war can continue for the next 4 to 5 years. The Ukraine war is still going on, and this war is directly impacting us.
Tariffs are rewriting trade. Dollars are being questioned. Gold is screaming. Fiat currency itself is under pressure.
That somebody who comes to me with a 10 crore portfolio, I advise them differently versus somebody who comes like portfolio. I will not tell them that you go and invest in US markets. But somebody who has a 10 crore corpus, I say you cannot invest more than 50% in Indian market.
Then came AI, OpenAI, Anthropic, DeepSeek. Every week a new model. Every week a new uncertainty. Nobody knows what anything is worth anymore. Not governments, not institutions, not Wall Street.
Institutions like Jane Street, Citadel are there, who are high frequency traders, and they have like billions of capital to allocate. How should a retail investor beat them?
So what does a thinking investor do when the entire system is being repriced?
They were manipulating, and they were able to manipulate because there was no other counterparty to stop that manipulation.
You don't forecast, you position. One man has seen it all. Jayadrath Gunjal, co-founder Kevala Capital.
So one who has the ultimate knowledge of the universe, he sees that, you also are the same thing, I also am the same thing, we are made of, one continuity. So somebody who has all the knowledge in the world, he is detached from greed, fear, karma.
Markets, geopolitics, philosophy. This is that conversation. This is the Invexora podcast.
First of all, welcome to our podcast, sir.
Thank you.
Yeah, it's very good to have you on here. So let's start with your brief introduction.
So I am Jayadrath Gunjal, and I have started Kevala Capital as an investment advisory firm, and our aim is to make individual retail investors educated in the art and science of investing, so that they can compete with the biggies of investment world. Our philosophy is rooted in behavioral finance and factor investing. So one helps with how to modulate our emotional reactions to market news, information, noise, and factor investing deals with the science of harnessing returns. So what is the science behind getting or earning alpha? So we want to propagate these science-backed methods and philosophies to retail clients, so they can take advantage of the best-in-class knowledge and methods of generating alpha in markets.
And you have also done your education in one of the prestigious universities in India, which is IIM Kolkata. And you have also worked in big corporates such as Airtel and Ola. So we'll like to have your perspective on that, and what were your learnings in those periods. Please share your journey from education to what.
Okay, so basically I am a electronics engineer, and I have studied in Vishwakarma Institute of Technology, Pune, and I was studying there from 2005 to 9. And I became an investor, started following markets in the bull run of leading up to 2008, the biggest market crash in recent times. So that time a lot of retail people started participating. So I was one of them. 2006-7 I got a PAN card. I opened a Demat account via Reliance Capital. So that time Reliance Energy was the biggest IPO at that point of time, and Reliance Capital being their investment arm, they were propagating people to open their accounts and invest in the IPO. So that is the way I got into markets. And that time I didn't have much interest in joining the TCS, Infosys, truck companies we used to call them, because they used to hire
In bulk, yeah, right.
So they used to give around 3.5 lakh package, which is also the package today. So somehow that didn't appeal me. So I was looking for other ways to apply my mathematical or analytical mind. So, and markets being markets, they pull in people at the top of the market level. So that is how I started my investment journey. And 2008 we were invested, and we saw the crash, and there were headlines in the news like Sare Zameen Par, from the movie Tare Zameen Par. So it was Sare Zameen Par. That was a headline in Economic Times. So that is how the investment journey started. And once we realized that it is not that easy to make money in the market, you need a lot of things. You need to understand a lot of things to how the market works, etc. So I had some of my friends in IIT Kharagpur. So I asked them that what is the, how do we, what is their view? So that time they used to say that the people in IITs in second or third year, they start preparing for their investment banking placement roles. So they start preparing for a CFA. So that is how he sent me some material that you should go through this. This is what people go through, people refer to. And by reading that material, I got the first glimpse of, markets beyond what is there on the news, and how the core knowledge base of where to start.
A deeper information.
Deeper information.
Which is not typically shown in.
Yeah, so nowadays there are a lot of material like Zero the Veracity and YouTube. There are other channels. There are a lot of companies like you who are doing a good job in educating investors.
Right.
That time in 2007, internet access was there in only college labs. So I remember I placing my exit from Reliance was placed in the institute's practical lab. So that is how the information asymmetry has currently dissolved, and whatever tools, data institutions had access to, now most people have access to that, and access to that on the phone. So that was the first entry into it. And since I didn't want to do a typical IT job, and I was I was acquainted to what is happening in the investment world through my friends who were preparing for investment banking roles in IITs, and I being studying CFA curriculum. So that how I said I want to join the same field. So I took my first job in Karvi Comtrade, which was the commodities trading arm of Karvi. So Karvi, if you know, today is KFinTech, the registrar arm which is listed right now. So their commodities broking arm, I joined in Pune. And at Kevala, my boss at that point of time in Karvi is my co-founder, and he's my mentor. And after a decade of knowing each other and working together for two companies, so we said we want to take a new plunge into this. So I started with commodities trading, commodities investment in Karvi, then later moved to ITI in Mumbai. So today ITI is ITI Mutual Fund. So that time they were having the broking arm. So there I started to look at currencies also. And at that point of time, currency options was newly launched. Currency trading, currency options, people wanted to participate in that. So lately they have put in restrictions to currencies derivatives, but that time it was a budding market. So currency options got newly launched. So Anurag, my co-founder, said that we should offer that to our clients. Why not you design some strategies? So at that point of time, having exposure to currencies and commodities, where technical analysis plays a lot of role, and option strategies. So mixing, matching both of them, we created some strategies for our clients. So and that was kind of the gateway into the options trading that we do currently. and alongside that, I completed the CFA level 2, and I was giving attempts to CAT also. And in 2011, cracked CAT and joined IIM Calcutta, which is the finance campus, in 2012. So, having a background with clear 2 levels of CFA and IIM Calcutta, I was like, I am set for finance career. But once you reach campus, you are a very, small fish in a very big pond. There are like brilliant people, very smart people, very driven people, very hardworking people. So competing with those, that you get to feel, what the competition in the world, what does world class competition mean? So
One of the, I mean, all the smartest mind in India are there. So it is a very competitive landscape there. So what was your feeling, and elaborate on that?
so like so Ahmedabad has a different culture, uh, Bangalore has a different culture, and Calcutta has a different culture. So in terms of Calcutta, it's like, very open in terms of what the student wants to pursue. And if you look at Ahmedabad, it is more of a, rigorous training camp, boot camp sort of a thing. So in Calcutta, it was like, you are free to pursue your passion, free to pursue till the last, if you want to be very technical, so you can do that. And if you want to explore different things in terms of, you want to do finance, you want to do marketing, so that way it was a very fluid curriculum. So that way we got exposures to, a lot of other things that today I think, having only pure finance knowledge is not important in investing. You need to understand industries, need to understand strategy. So that way it played a role in opening up a lot your worldview. So like one of my favorite subjects there was history of Indian business. So how the Marwadis went from Rajasthan to Calcutta, how they, what kind of business they did, what type of business practices they adopted. So those are very different than the Western concepts of business. How Indians do the business and how a Western corporation does their business is different. So how did the Indian business evolve, and how did, when Britishers came in, they brought their practices. So how did these two interact? And that led to the Tatas, the Birlas of India, and how they changed the Indian business landscape. So when you understand, how India is different, how we fit into the world context. So though it is not very much related to how a balance sheet is, or how accounts should be run. So having that perspective opens up your mind, and you see a world in a completely different light. And as business leaders, I think that is more important than technical knowledge after a certain point of time. Technical knowledge is important, but without having this broadening of vision, so that thing happened there, and it was a crucible of people coming from different industries, having worked in different industries, coming from different places inside India. There were a lot of people from outside who came in, exchange students. So I went on to do exchange in Brazil. So that opened, how the South Americans do their business. So European way of doing business or the Western way of doing business is also linked to the culture, right? So Britishers do the business differently. French people do the business differently. Let's say Spanish people do their business differently. So their cultural nuances gets baked into how you interact in business. And business is nothing but person to person interaction. So Europeans may be very direct in terms of, I want this, can you give me this? The transaction is very clear on the paper. But Indians will not state their objectives or what they need directly. And so there is a lot of scope of misunderstanding, and if you read the undercurrents, then you are able to do the proper business. So direct interaction is indirect interaction. So these kind of exposures you will never get without actually being in those geographies, interacting people with different cultural backgrounds. So that way also it gave us a global perspective, and how to treat other people's cultures with respect, how to learn from them. So I think that has played a bigger role than the academics in the journey that I have had ahead.
Because you got the ground experience, how cultures work, how people interact, and uh, practical knowledge basically from the education perspective and all. Yeah. So
So that also gave me an opportunity to work with Airtel in their Africa operations. So though I wanted to be part of Dalal Street right after college, but having grown up watching Discovery, Nat Geo, and also wanted to I had been to Brazil, so wanted to travel and see more of the world. So when I got the opportunity to work with Airtel in their Africa operations, I said, okay, I'll take this opportunity and maybe explore finance and markets later. So after that, when I was in Africa, that time I said, okay, I'm now missing out on what is happening in India. A lot of startups are coming up, and obviously markets being my first love. So I came back and started a company with my IIM friends, and that time we were making a chatbot based advisory. So what you see today's LLMs, ChatGPT, Claude, etc. So we are trying to build something similar to that at that point of time, but we were naive in terms of having that high dreams, high target, without understanding how technically challenging it can be. So that was one aspect of how to deliver advice to retail clients. So chat being a very natural way of communication. So we thought it should be chat based versus a app based kind of interaction. So that was one of the thesis. And second was to how do we automate research, right? For retail clients, one is not able to do a lot of research at the depth of which institutions do. So institutions rely on a lot of research that is done by very qualified people. Some of my friends from IIM are currently working in there in those equity research roles. So one person will have a 2-3 people team. They look at one particular sector. Then there will be people, a team of 10-15 analysts which cover all the sectors. Then there will be one chief economist. So after all these people do proper research, then they are able to advise their institutional clients. So at a retail level, people don't have the time, don't have the expertise, and don't have the wherewithal to do that kind of research. So how do retail, do their research or invest in proper stocks? So, and how to use technology to bridge the gap. So that was the challenge. That was the opportunity then, and that is still the opportunity now. Now the technology has matured a lot, so that now I think it's the inflection point wherein retail can really use the tech stack to do this kind of things. And that is when along with my studies of CFA, I stumbled upon the factor investing way of looking at the markets. So since 2016-17, when I left my job at Airtel, came back from Africa, that is the time when we were doing research for how do we automate a lot of research activity. That is where we came up with, came across factor research or factor investment.
Like before moving to like factor investing, could you like give a perspective of how was the financial markets in Africa, and could you differentiate it with Indian markets? What are the points that differentiate both?
So, African markets, in terms of equity, they are not that penetrated, and even Indian market is very highly matured if you compare it with them.
So they are not as volatile as Indian markets, right?
Uh, Actually, honestly, the market participation is not that high. So how the common man talks about Sensex, how the media is there. So that way, it is not that much in Africa, and I would say it might be different in some other countries, maybe Nigeria, South Africa, where I have not stayed. But in countries that I have stayed, they don't have a very investment culture as such. So they mostly rely on the financing or the finance knowledge or the capital markets that has been running in through Europe. So even though if you look at Bharti Airtel got listed, it got listed on a European exchange. Their African arm got listed in the European exchange. Airtel didn't go and list themselves up in individual countries in Africa where they operate, but they got listed in. So that way, it is the capital is flowing either from Europe or it is flowing from the Middle East. So that way, those markets are, still there are a lot of scope to develop over there, because those are mostly controlled by by private creditors or institutional. Retail participation is not that much. So if you have to compare Indian markets with any other markets, I think the US market is a very the right market to look at, because culturally also we follow European culture, European US culture, European and US news a lot, and uh, US being a dominant player in the world markets, so we take clues from what is happening in the US, because they are very innovative in terms of, if you look at the European markets, they are also very conservative. So if you look at the most conservative European markets would be the German markets. Still,
And USA also have a lot of influence across all the indices of all countries. So that is also one part of it,
yeah.
right?
So Americans are basically, their view of risk is opportunity. They don't view risk as risk. Europeans are very risk averse, and Indians are somewhere in between, right? Some of our communities are very risk taking. Some of our communities are very risk averse. So we have a mix and match of that. But I think we tend to borrow a lot of things from the Americans, and I think that is also the right thing to do, because look, their view of risk is opportunity. So a lot of new innovations in the financial markets, in other markets, is coming from Americans rather than any other place. Now Chinese, obviously they are giving Americans their run for their money, but that is another completely different ways of working in finance.
So let's get back to where you started Kevala Capital, and please share your journey, how you started it, and what's the SOP you follow, how you onboard your clients, and what's the strategy you use.
So as I mentioned, that we are a factor investment firm, and we rely on two major scientific models. One is factor investing, and the other is behavioral finance. And in some way, both are interlinked. So in the 1970s, in Chicago School of Business, there were researchers who were saying that what are the different traits of a company that leads to a good investment. So they were trying to search for the holy grail of returns, as to what are the attributes when we look at, let's say, the matrimony industry, we say what are the attributes of a good groom, a good bride. So we have some list,
KPIs are
KPIs
there.
are that. So that time in the 70s, people were looking at what are the good KPIs for a good investment, not a good company but a good investment. So if I follow these rules, can those rules lead to a better investment or not?
And what were the KPIs from that time period?
So that time, the first, uh, equation that came up with was linked to the capital market line, or you can say, there was only one risk model, one factor risk model, and that model said that okay, if you invest in equities, you get higher returns. If you invest in high beta stocks, you are investing in high risk stocks, and you will get compensated for that high return, but through high return. So there was a linear relation between risk and return. So you start with, let's say, fixed income, which is fixed income in terms of government securities, that has lowest amount of risk. If you go on to corporate bonds, then it is slightly higher risk. Equities has a equity risk premium. So that is the first risk premium that they talked about. And in equities also, if you invest in the market, like all the companies in proportion of how big they are, then you are exposing yourself to market risk. And if you go into small companies, if you go into high beta companies, then you are getting higher returns and you are getting compensated for the higher level of risk. So that time the view was very linear in terms of, if you take high risk, you get higher returns, and everything was linked to market beta. Then later on, people came up with a three-factor model, that okay, market risk is one factor that gives you returns. Then the other one is if you invest in small companies. So small companies are also more riskier than large companies. So people need to get compensated for that risk. So again, that is also one of the factors, that investing in small cap companies gives you higher returns. But again, this view is also linear in terms of risk return. You are taking on additional risk by investing in smaller companies, so you are getting higher return. Then the other model was with respect to value stocks. That if you invest in stocks which are of low PE, low P by B, so you will see higher returns. And then people were researching, okay, this is the phenomena we have seen, we have run our models on data, and let's say investing in low PE companies, low P by B companies, over a 5-year, 10-year window, you get higher returns. Then why are you getting those higher returns? So the view was that investing in low P by B companies, low PE companies are basically out of favor companies, right? Why would a company be available at a discount to their book value, at a very low sales multiple or earning multiple? That was a concern. So people were not willing to buy these companies because they might get bankrupt. Currently that sector is not in favor. So investing in those companies was a counter-cyclical measure. So you were taking on the additional higher risk of chances of bankruptcy compared to other companies. So again, it was a very risk-driven model, that you are taking higher risk by investing in these companies which can shut shop. So that's why you need to be compensated. So that was primarily the model for a very long time, and it was completely logical or intuitive, that you invest in small companies, you invest in riskier companies which are currently facing headwinds, so you need to be compensated for that risk. So that was the model in the beginning. Then some of the researchers from the same university said or found out through research that people who invest in companies that have been trending over the last 1 year, over the last 6 months, 3 months, continue to perform in the next 3, 6, 12-month window. And that was empirically proven. Okay, this happens in Indian market, this happens in European market, this happens in US markets. This has happened for many decades. So it's not a phenomena that is here and now. So it has been happening, and it is happening. It is ubiquitously happening. So
it's backed by historical data.
it is backed by historical data. So now they were pondering that what is the logical reason behind this phenomena. Now this phenomena basically is nothing but momentum, is nothing but trend. So logical risk reward methodology, people were trying to ascribe or describe why momentum or why trend following leads to higher returns. They were trying to reason from the same risk premia point of view. So that time, what the view was that people who are buying at a 52-week high, people who are buying into companies that have already performed well in the last 3-6 months, seem to suddenly crash. And when the market sentiment turns, or let's say let's say the current example, like crude went from $60, $70 to $100, $110, and it was a trending move. So do you want to buy crude at 100? Do you want to buy gold at 1 lakh? So we see sudden crashes coming in that kind of a market. So trend following basically has a risk of sudden crashes. It has risk of high volatility. So that way it was reasoned that because of these risk involved in this kind of investment style, one should be compensated for that, and it is not very likely that people will go and follow these methods. The other view then started coming up was with the mix or the lens of behavioral finance, that all these risk premia that exist in the market, they exist because markets is made of humans, and humans behave with greed and fear. So as long as markets are driven by humans and their primal emotions of greed and fear, these kind of opportunities will exist. So what is the behavioral reason for existence of some of the factors, like, and momentum being a very whether it is, if it is counterintuitive in terms of risk premia, then it becomes more of a behavioral reason that why the factor exists. So like not a lot of people are comfortable at buying at all-time high, at 52-week high, and even if they buy at that point of time, what do? They see a 10-15% return and then they cash out. So, and if they see a drop of 10-15%, they keep on holding. So human behavior or retail behavior or market participant behavior is of cashing in your profits and holding on to your losses. So these behavioral trait leads to the trend being persistent.
Basically buying at 52-week high, and if the market is falling, you keep averaging, okay, right? You keep averaging or you hold that.
No, so basically averaging can work in, let's say, a value kind of an environment when your strategy is value driven strategy. In momentum driven strategy, you have to cut your losses. So what happens usually, or what happens in trend following, is that you catch a trend. There is one stock who is breaking out of a pattern and making all-time high. So you invest into that, and 7 out of 10 times it will give a new high, right? So if you have been unfortunate enough to invest in those 3 times where it reverses at your entry, which is like a fake breakout, then you are very sad, because as humans, we have a larger emotional reaction to losses than to profits. So even though the probability is, let's say, 7:3, but that hits us harder, and we feel the loss more in a worse manner than we feel about profits. So even though probability or the mathematics is behind you, your emotions don't allow you to take that trade. So if you are able to pull the trigger 7 out of 10 times, you will or 10 out of 10 times, you will face profit in 7 times, you will face loss in 3 times, and you have to cut the loss also. You have to let the 7 trades take their course, and you have to like cut out of those 3 trades. So if you have the temperament to follow that strategy, or follow, so you have to understand why does that factor exist, and as a individual, are you able to do the opposite thing, either because you have balls of steel, or you understand the factors, or both, right? So that way it will give you money. In terms of when you say averaging out, right? Averaging out is classically a good way of investment if you are a bargain buyer or a value based investor, or somebody who ascribes to the investment philosophy of Berkshire Hathaway, of Warren Buffett. So Warren Buffett, in his recent interview, he said that you are sitting on so much cash, then how is the current market? How are you looking at? So he said this is nothing. So what his way of investment is that you invest at a certain valuation, certain PE level, and you cash out at a certain PE level, right? Historically, your valuation multiples are mean reverting. So you keep on investing where the market valuations are cheap, and you keep on cashing out when the market valuations are high. So that is a systematic strategy, right? And what he said was basically, currently whatever cash I have, I will deploy 20% of that if the market falls 20%, another 20% if the market falls 40%, another 20% if the market falls 60%. So he is prepared for a 40 to 60, 70, 80% fall from the current market levels. And he said that he has seen falls of 40% in his portfolio. So current market crash is nothing when you compare it to how much markets are volatile and how much drawdowns they have seen historically. So since he is primarily a value investor, his strategy is to cash out in euphoria and deploy when the sentiment is very bad. That is opposite to what momentum investing is, and both ways of investing work for different kind of people. So and if your mental agility is very high, that you can switch models as per the market. Let's say in bull market you are a momentum investor, in a bear market you are a value investor. Very difficult to do it, but if somebody can wear both the hats, then his returns will be even greater than the best investors that are there. So averaging at lower levels depends upon what strategy you are following. You cannot be that I am a momentum investor and then you start applying value investment methodologies to a momentum strategy.
So one should be stick to a strategy and follow the systems.
So one has to first identify that what is his core inclination towards risk. It's a very personal temperament. Like the two major, you know, diagrammatically opposite factors, and these are meant for two very different kind of investors. One who likes to average when the markets keeps going down and wants to sit on cash when the market premiums are very high, and the other one is who tries to run with the bull market and cut his losses short when there is a bear market. So these are meant for pretty different investor types. So knowing what kind of investor you are, or what kind of strategy one is deploying, is very essential. And these factors are there because of the risk premium also, but it is also because of human behavior. So one has to ask whether one has the temperament of doing the opposite thing because of which the factor exists in the first place. So if you are that kind of person, then you can basically uh, take the fruit of following that strategy.
Like, can you give an example of your clients, the things you noticed in them?
So currently, I would say the most difficult part of my interaction with clients is to understand what kind of investors they are, uh, and most people don't know what kind of investors they are till the point they face a loss. And when you are talking about the loss they are seeing, whether realized or unrealized, and we have a conversation at the start of the journey. We have a risk assessment form in which we try to gauge the same traits of what kind of investors you are. Basically, do you look at the market every day, every month, every quarter? So what is the level of interaction with the market? So, and what is the kind of returns that you are looking at? Are you looking at market to get market links 13-14% kind of returns, or you think you can identify small cap stocks, you can identify those opportunities, or you want to play the current themes that are very hot in the market, or you want to invest in companies that are there for a long time and you think those are safe bets, or known companies. So based on this kind of questionnaire, we try to gauge where the inclination of the client is. So if the client knows his ideology and answers honestly, then it is much easier for us to prescribe what factors he would be comfortable with. Because you follow any strategy, you follow value strategy, you follow momentum strategy, in the long run you will make similar kind of money, uh, but you have to follow it for a good 10 years. And over that course of time, you will earn that high premiums that are linked to these factors. But you have to be in the market for those 10 years. You have to follow those things systematically. So in the beginning, what happens is that uh, people are like, no, I want to invest in, let's say, the AI theme right now, right? Or defense theme that was running couple of years couple of years back. Now it is again coming back. Or people want to invest in new IPOs. So they have these kind of ideas about investing, and mostly it is coming from the current media that is there, social media, or even the TV news channel. So it is uh, you know blurring their vision in terms of what is investing about and what kind of investors they are. So over the course of investment with us, they come to realize that, okay, momentum investing is maybe not for me. I cannot see a portfolio which saw a 10 lakh profit in a month's time over a 1 lakh 1 crore AUM, and we give 5 lakhs out of that in a single trading day. So that is the way momentum works. It will give you handsome returns, but it will also have momentum led crashes which will wipe off your profit in a day.
It's very time sensitive, and one should be aware that things can go up and down, and one should be stick to the strategy of whatever the advisor have designed as per their tailored to their uh, situation.
One is what they want to do, and the other thing is what they can do or follow for the long term. So that things are not aligned always. And as a advisor, you have to first caution them as to, these things need to be aligned. And many of the times investors are like, yes, you are right, but they don't internalize that until unless they see a loss or they see a deviation in what they were saying and what they are feeling in the market right now. So that way, over the course of time, uh, some investors adjust. Okay, this is not my style. Let me go to buy and hold, right? That is also a good style, but then that is also a very difficult style, right? So over a couple of cycles, one realizes that okay, this cup is for me, this cup is not for me. So being in that journey as an advisor, you have to educate them, you have to give them the right knowledge, the right direction. So that has been the most challenging part. So the science is not rocket science, right? It is like what is value investing? Value investing is nothing but you invest in companies which are low P, low P by B, low price to sale, low EV by EBITDA, and good dividend yield. These are the 5 KPIs, and those are available on Screener. Those are available on any platform very easily nowadays. So, and this science is not going to change or evolve dramatically, but the temperament, the emotional aptitude that is necessary to follow this strategy is difficult, and cultivating that strategy in investors is the real task. So that is where having the knowledge of behavioral finance uh, comes in handy, when you tell people that what you are feeling is human and everybody else has the same feeling. I also feel very disheartened when I see a red day, but since I know that this is part and parcel of investing, I am okay with that. That level of maturity has come either from seeing a lot of such days or knowing that these kind of days exist. So giving them that background, okay, what you are feeling is called loss aversion bias, that you don't want to book loss. When I'm telling that cut this position, this is going to make you, face you more loss, so cut this position. So they don't want to do it. It is loss aversion. Then there are other different kind of biases that people have in investing, and not just investing, in general other ways of life also.
So that is one of the bottlenecks convincing clients that these all things happen, and you have to be ready for it.
Yes, one has to be ready for it, and the more they learn about it, if they learn that okay, momentum investing gives you the maximum return at the maximum level of risk, but what does that mean when you have to see it? What does risk mean? Risk mean basically seeing a drawdown from what profit you had made. So risk is nothing that why is volatility risk? Because volatility plays with your mind saying आज profit में, tomorrow we are in loss, again we are in profit. So that kind of green red messes with your psychology. So that's why it is difficult. If had been equity investing a straight line, giving 13% a year, 1% every month, so everybody would have done that, right? So that 13% on an average that market gives you is not linear. It will give you 40% in 1 year and minus 20 in another year, again 15% in next year. So you have to take it in that stride. So once people understand that, understand other subtleties relating to, why is it that, I invested at this level and then there was a news that is highly negative, but then still it is rallying. Or why is economics and markets not going hand in hand? So all these nuances, when they start to understand through an advisor, through learning, through understanding psychology of investment and their own temperament, it is it is when they realize, okay, how to become a better investor. And our emphasis or our role is more on that than telling them what is the right model or right formula by which you can get. So people focus more on identifying, okay, I have done this research, I have
A lot of DIY stuff.
DIY stuff. What they do is basically trying to find stocks. Okay, let's say solar energy is in vogue. Let me find which companies are getting contracts. Okay, then they will invest in those companies. Now, it is a good way of investing, but there are so many other factors involved that some news comes, okay, China has done this, US has done that, cost of raw material has increased, decreased. Then the whole analysis goes for a toss.
Because it's very surface level, right? They didn't don't get the information like what really happening, and by analyzing those points.
Even if you have found out a good stock, you have done the correct analysis, market by nature will try to shake you out of your position. That is the nature of the market. So it will test your resolve. Okay, you have found a great stock, great P level, great business. Maybe you know the founder, you know the area, you work in the same field, right? But it will still test your resolve to give you that multi-bagger return. And people, if they have chosen 5 stocks, 6 stocks in concentrated industries, then maybe in 5 years down the line, their thesis was correct all along. But over those 5 years, market will show you so much turbulence, so much good news, bad news, this policy, that policy. So it will try to test your resolve. So either you have that strong resolve on your own analysis, then you are able to do it. But even if you have that, when you start seeing losses, that resolve is going to break. So that's why people say you have to diversify, right? Even
Experts like you came in and you handle the overall situation based upon their portfolio and all.
so even though people have their thesis, right, those theses needs to be in line with the risk appetite. So people need to ask whether, okay, this is the so I personally am against stock picking. Stock picking should not be done by retailers. It is not their cup of tea. There might be few people who learn that art, who implement that art, who make big bucks out of it. There will be people, but on an average, people fail at doing it for same reasons that they are not able to do the math properly, they are not able to have that resolve, they don't do risk management properly. So the easy approach for retail is to trust a science that is stock agnostic. So when we say low PE stocks, right, it doesn't care whether that stock is a IT stock, whether that stock is a banking stock. Obviously, there are some parameters that needs to be adjusted for different sectors, but the philosophy doesn't judge on basis on the type of stock or type of industry or the story behind it. It is in the numbers. So if you follow that methodology, then maybe you are betting on companies which are not in fashion, right? So that way you are likely to gain when the story turns around. And the nature of the universe is mean reverting. So failure itself lays the foundation of a success. You must have heard about the phoenix, right, who rises from its own ashes. So that is the nature of things. If things go in one direction, so the pendulum has to swing back also. And then laws of nature will see to it that it moves in that direction. So that happens in economics also. So companies which are making a lot of profits, so a lot of capital gets attracted to those industries, and once capital gets attracted to those industries, the return in those industries fall. Return in those industries fall, then capital moves out, then again those becomes cheaply available, then again people will enter. So that is the cycle in which uh, capital rotates, because people are looking for opportunities. So one who is able to see that those market cycles, enter in those market cycles at the right point of time, ride that cycle, get out of that cycle without being emotionally attached to your analysis, to your companies. That is how you have to dissociate yourself from these things. So, and that is where we came up with the name Kevala. So Kevala Jnana is basically the ultimate knowledge in Jain philosophy, in Hinduism. So wherein you are attaining a state of salvation by knowing everything in this world, the ultimate knowledge. So one who has the ultimate knowledge of the universe, he sees that you also are the same thing, I also am the same thing. We are made of this one continuity. So one that has happened through the form of having all the knowledge in the world. So somebody who has all the knowledge in the world, he is detached from greed, fear, karma. So that way, a investor who is able to shed off his human emotions of greed and fear and look at markets in a view of only knowledge, that what is right and wrong. So that is the ultimate state one has to achieve, that he has to see the markets without getting biased by his emotions of greed, fear, social media influence, news cycle, because all this will try to keep you trapped in that loop. So that is when we thought, okay, this is something that we want to propagate. We want people to know that how do we dissociate our emotions from the investment process. And that is the time when okay, what are the steps that are needed for somebody to follow that process. So one is having the proper knowledge of the different factors, having proper knowledge of their own emotional biases, their own risk temperament. And even though one has that, when the day comes to invest, when the day comes to exit, people, there is some voice in their head says that let me wait for some time. So for example, one of our clients, we had advised them into investing in Nifty mid cap small cap momentum 100 index fund, because he said I wanted to invest in momentum based strategies. And I said, okay, momentum based strategies plus small mid cap will give you exposure to two factors, size and momentum. But I told him that you have to follow the process, and we will enter the market in the bull run and we'll cut our losses when the bear market starts.
One has to be like resilient and have patience as well.
Yes. So we told them, okay, you have to cut your position right now, even though it is right now at so it was around like couple of months back only we entered. And last month, even before the war started, there were signs from our models saying that now we have to go on a risk off mode in the momentum strategy. So I told him that you have to sell the ETF. So next day the market was up 1.5%. Momentum also was up 2%. So he thought maybe I'm at 12% loss now. My loss is at minus 9%. So let me wait. So he didn't pull the trigger that day. So after a week, I asked him that did you take the position? No, I waited for one day, and then from next day again the downside started. So even though there is, he knows what is momentum, he knows what is the method, but when it comes to execution, that time something in the mind, tells you, hey, wait, you can do it, 1%, 2%. So that is the human nature. So how to avoid that human nature, even after proper knowledge and understanding, has to be in the system itself. So we have designed one click execution, or you don't have to go and put in orders for each of your trades. It is just a one click thing, so that your actions are limited, so you don't think too much while doing it. What people will do, I'll say, okay, you buy these 5 stocks, buy these 10 stocks, right? So they will say, okay, I don't think this 2 stocks are correct, let me buy these 3 stocks and let me sell those 2 stocks. So when that discretion comes into picture, sometimes it works, sometimes it doesn't work, but our brain tries to fool us that, whatever right thing you have done, you will remember. Whatever wrong things you have happened, you try to forget that. That is how self preservation mechanism for of the brain. So over the long run, people don't realize that these manipulations that they do to the investment process leads to a negative result. So you have to limit your interaction with the market, and you have to do it dispassionately. So we have designed portfolios where it is, you buy all those stocks in one go, you rebalance in with one click, because we don't want to give too many options to people to that, and that leads to them to take uh, actions that are counterproductive.
So you have developed those triggers as well. And do you use AI in your this workflow that gives you the signal or any kind of things?
So AI currently, how we use it is basically to get all the data that is publicly available. So one of the places that you can find all the data is the NSE, BSE websites itself, and there are website linked to NSE indices also. So there you get a lot of data about individual companies, their announcements, and if you look at that website, so it's full of information. So how to get that information is one part of AI. How to structure that information is another part of AI, and how to use that information is another part of AI. So earlier it used to be that we have to get those things from PDFs, convert it to Excel. Now some companies like Screener do that thing, but you have to, let's say, compare 500 companies, 700 companies, or you have to understand those companies at different levels. So what Excel math we used to do, now we do it through the chat interface. So what we have developed is a MCQ kind of a setup, wherein we collect all the publicly available data, and we have structured that data, and we can query that data in a manner what earlier we used to do on Excel. So that is one of the automations we have implemented through AI. And the same thing we have done it with the backtesting also. So how we used to do backtesting earlier when we started doing it in 2017-18 was that we used to get data from Bloomberg, and then write a Python script on that, and then run that script, modify that script. So now there are a lot of platforms that give you that data, so we don't do that heavy lifting there. But the backtesting part, we have to write in the LLMs that what are the practices that we want to follow, and based on that, then that becomes part of the code. So the coding part, which is required for a quant based, factor based research, that now is very easy to do versus what we used to do in 2017, 2018. So that way, AI has done it has been very beneficial to us. And lately, the website that we are building, the feature changes that our partners ask, our broker partners ask, okay, I want this feature, I want that feature. So earlier we used to do it via different, front-end engineer, back-end engineer, etc. But now we are a very lean team that, I know what the customer or what the client or the broker wants, and I can input that to Claude, to Cursor, and I get that output. Even broker integrations for that matter. So now we can just give AI the API documentation, and they will give us a integrated platform. So that way the experimentation is very fast with AI. And when it comes to AI as investment, AI as your investment manager, that part we have not outsourced yet. So it is still as a research assistant kind of an AI rather than a portfolio manager kind of an AI.
It has not achieved that level of consciousness compared to an advisor or an expert, right?
So it can achieve, or it may be able to better achieve, because it is, the mathematical part, the analytical part, any AI will do much better than what I and you can do. But like I said, the difficult part is not the science. The difficult part is the emotions. So if you are able to completely trust the AI and dissociate yourself from the investment process and let AI take over as your portfolio manager, then it will do better than you. But can you trust? Can you trust it? So if you know how you have built the AI system, then it will be beneficial. But again, you may be able to deploy 10 lakhs of your capital, but will you deploy your entire capital with that? And what if there is some kind of red day, or when it is still part of, see, it will rely on backtesting, right? At some point of time, any strategy that you design via backtesting, and backtesting is based on what has happened in the past. The future may not be that way, and if it is not that way over a long term period, right? If you talk about 10 years, these things will hold true. But do you have the patience to wait for that long period of time? So people say, okay, I want to invest long term. Long term for them is 3 years. So 3 years is not a long term in investment world. So what most of the people who entered the markets 2020 onwards, they have not seen a proper bear market. COVID was not a bear market. COVID market recovered before you could, meaningfully, take adverse actions around it. So one of the markets, the bear market when I entered, 2008-9. So it was not until 2011 that we went back to the same levels of 2008-9. So it was still 3 years, right? If you look at the 2000 crash of Nasdaq, it took a decade to recover. Nasdaq, what it was in 2000 and 2011, it took a decade to come back to that level. So that kind of V-shaped recoveries we have seen, and we are not used to seeing a very long 3 years, 4 years, a decade of bear market. And these things happen. In Japan it has happened, in 70s it has happened, in 2000 it has happened. So, and these things will happen again.
But can this happen in Indian markets as well?
Yes. So, I also truly believe in Rakesh Jhunjhunwala's philosophy of, not betting against Indian bull market, or Warren Buffett's philosophy of not betting against America. But they are not talking in terms of 3 years and 5 years. They are talking about multi-decadal thing. So you cannot take one part of their philosophy and not the other part of the philosophy, right? So it can happen in India that we can see a decade of non-performance, or and we saw that in from, let's say, 2020, when we recovered back from the 2008-9 crash, till we recovered back in 11, and 11 again there was taper tantrums, there was EU issues, and market was flat almost till 2014, giving like lower returns than fixed income. And it is only after the current government came into power that we saw a bull market from 14 to 2020, then a fast correction and recovery, and that bull market has continued. So for a good decade we are in a very healthy bull market. So it can so happen that we can see at least 3 to 4 years. We saw 2 years of flat markets. We might as well can experience 3 to 4 years of bear market. And investors should be prepared to see that. Otherwise, there is no money to be made if one expects that markets are going to give me 13%, 14% return in a linear fashion. So that is a learning curve, and that is where risk management, allocating to different kinds of assets, not just equity, gold, even I would say crypto, real estate. So diversifying across markets, across investment styles, help you ride through that periods wherein you see a secular bear market for a couple of years. So that way, when we were seeing flat equity markets, but we also started allocating to gold much before it became a news clickbait thing. Why? Because in 2010-11 also we were seeing the same kind of returns in gold. Gold gave 20%, 30%, 40% kind of yearly returns in 2008, 9, 10, 11 kind of a period.
After that stumbled to a linear short.
So one has to understand what is the role of gold in the world market. So till 1970s, all the currencies people used to issue was linked to gold. When we moved away from gold standard is when the actual fiat currency and gold became separated. So whenever you see a quantitative easing kind of a action, that means your value of the currency is going to lose value. So maybe dollar will lose value, maybe rupee will lose value. So fiat currency in general will lose value if you are going to do a quantitative easing. So that time in 2008-9, there was 3 trillion worth of quantitative easing done. So Fed's books expanded by 3 trillion. So once you do that, it is some way going to get into inflation, and that way the value of gold is basically something that acts as a counter inflationary measure. So gold will give you bulk returns in this 3-4 years period right after quantitative easing. So you see bull market in equities also, because so much money is getting pumped into it. You see bull market in gold also, because that money is going to lose value. You are making 40% return in the market, but 10% of that is going to go to inflation. Earnings are rising for companies because they are selling products at higher cost, and you are buying those products at higher cost. So returns in terms of your buying power has not been 30, 40, 25%, whatever people have seen in the last 4-5 years. Their actual return is not that much if you adjust for inflation. What you could buy in 2020 and what you can buy now is materially different, and it's not been a decade. So quantitative easing has its impact, and it gets reflected in gold. So from that, in 2020, 2021, there was 9 trillion worth of quantitative easing, 3x than what we did in the global financial crisis. So obviously your metal prices, your gold prices are going to catch up to that, and you will see those returns in a very short period of time. So that is how we placed ourselves, reduced the exposure to equity and increased the exposure to gold, to other metals. Now this is also one form of, this is the logical or the economic rationale I gave it to you, that why we should have invested in gold or silver, right? Now giving this rationale after the rally is very easy, right? But you have to have a non-economic rationale also, that when to enter, right? Because economic rationale can take time, and being right in the right time also is important.
It's very difficult for retail people to capture that, right?
No, it is not difficult. They don't have the knowledge is the part. So what we talked about is the different factors in retail investment, right? So one is momentum, one is value. We'll touch upon quality, low volatility later. We talked about size also. So that way, what momentum we talk about in equity market, that is cross-sectional momentum, that we are investing in stocks which are performing better compared to other stocks. That is cross-sectional view of momentum. Now there is one time series view of momentum wherein you invest in anything that is going up and you short anything that is going down, irrespective of whether it has performed how with respect to other things. So what we do is that in that sense we look at all the major types of investments. So equities is one of them, rates or bonds is one of them, currency is one of them, commodities is one of them. Commodities can be split into bullions, which is gold, silver, energy, which is crude, natural gas, and metals. So if you look at all these markets, and agri also, soybean, then there is lumber. So all these things are traded quite heavily in other countries. We don't have that much exposure in India, but you have the data. So whenever the market gives you a signal that gold is rallying, gold will give a breakout, right? Gold will outperform for 2 months, 3 months. So that is where, as trend following managers will get the signal to go into gold. Same way they must have got into crude oil right now, right? So, and they would be out of the equity market because they are seeing a flat growth, or they must have moved from Indian equities to US equities, because US equities has been still trending over the last couple of years. Indian markets has not been trending. So whichever equity market is trending, let's say European market, African market, China market. So based on futures, trend following managers move their capital across different markets of equity, commodities, rates, currency, etc. And within those markets also they move across geographies. So if you apply a rule-based mechanism, which is nothing but what trend following managers do, you are able to see, okay, now I should move from equities to gold. Now I should move from gold to, let's say, crude, or I should move from Indian equities to US equities. Whatever is your comfort level, you get those signals that I should, diversify, time-based diversification across these segments. And at least, one should, if one doesn't want to time the market, one should have a healthy mix of exposures to these kind of markets. You should not be completely invested in the Indian equities. You should diversify into US. You should diversify into other geographies. You should diversify into real estate. You should diversify into commodities. So For that, one has to obviously have a certain size of the portfolio. At a smaller portfolio size, one cannot diversify across this. But as and when your size of the portfolio increases, your need for diversification also increases, and the capacity of diversification also is supported. That somebody who comes to me with a 10 crore portfolio, I advise them differently versus somebody who comes with me with a 1 lakh portfolio. I will not tell them that you go and invest in US markets. But somebody who has a 10 crore corpus, I'd say you cannot invest more than 50% in Indian markets. You cannot invest more than 50% into equities alone. So that way, at a higher level of portfolio size, one has to apply these different methods, and then these different methods help you, navigate the world markets, the 4 or 5 years of underperformance better than just doing buy and hold in one particular small market, or doing buy and hold in only 5 number stocks. Now this is a very unpopular opinion, but I have not invested ever in HDFC Bank.
Why so?
See, logically, for HDFC Bank to give multi-bagger returns at such a size is not possible. Plus, the valuations have always been at a premium, and people who have HDFC Bank as a core portfolio of 5 stocks, in that one is HDFC Bank. It is very concentrated. So as a diversification also, I would not want my exposure to be in one single stock of by more than 5%. But people have 20% of their portfolio in HDFC Bank. And what has happened to their returns? So, and your smart capital, your institutional capital, move from HDFC Bank to ICICI Bank, move from there to SBI. So they are not married to any name. They look at valuation, they look at the opportunity, they look at other very basic nuances, and then they move their capital. So how can a retail do it? Retail doesn't have that acumen, doesn't want to interact, doesn't have the ability to interact with management. So how can retail take these clues, right? So that clues is taken from what is happening in terms of price. Now, what price means is that, like, from last 3 years, HDFC Bank has been in one band, fluctuating in that band. So either you do jobbing, buying at the bottom of that band and selling at the top of the band. You can do these things, but buy and hold strategy in that stock is not going to work. And same way you look at ICICI Bank, it is not stuck in that price band. You look at SBI, it is not stuck in that price band. So money is flowing, right? So one has to take clues from the price movement. Now technical analysis is frowned upon, that this is a shallow science, or but you have to take clues from what is the market structure, how is it performing with respect to market, and all stocks behave in a particular manner with respect to price and volume, and all these signals that institutional money gives you, that are there in the prices, and the prices are reflected in the chart. So if you are able to see that, it is not from a trading point of view, but from a structural point of view, you can get clues. Okay, where is money moving? So that way, retail has to understand and respect those chart patterns also, those breakout lines also, So that knowledge and that understanding one needs to have.
Elaborated this very beautifully from psychological point of view to other things as well. Yeah. So like moving to the current situation, current geopolitics, like whatever happening with Israel, Iran, US has a big influence on that. So how does a retail investor should do things in a particular way that it's in their favor?
I will give you from again the same lens as I read the markets, right? So one has to understand that what is their strategy. So for a momentum investor, if one is a momentum kind of an investor, uh, momentum signal is to stay on cash. That is one. Secondly, if you are a value investor, then it is a good time to deploy. But how much? As Warren Buffett recently said, at a 20% drop, you deploy 20% of your capital. Right? So if one has, let's say, not withdrawn in the bull run or is completely invested right now, so one has to invest that much amount of money that one doesn't require for the next 10 years. So 3-year view is, as I said, is not a long term view. So people say that I want to buy a house in 5 years. I am saving to buy a house in 5 years, and I want to invest in equities and build my corpus. It will work beautifully in a bull market. But if the next 3 years is a bear market, and if property prices rise because of supply chain disruption, steel becoming expensive, energy becoming expensive, so it's not that that real estate is becoming it's a hot cake, so we should buy, but the input cost of building a house will increase. Inflation is going to increase. So that way a 3-year window or a 5-year window is too small. So one has to invest through SIP if one is of that view for a 10-year horizon, that you don't require that capital for 10 years.
Yeah, because like right now, like everyone, whether that's a retail or institutional, everyone is facing red, okay, on their portfolio. So they should be focusing on the long horizon, right?
Yes. So if you are doing a SIP, which is not going to strain your current lifestyle, you don't need the money for the next 10 years, right? So your corpus to buy a house is something different. So if you want to buy a house, let's say 10 years down the line, then maybe this strategy is going to work, but not a 5-year horizon. So one should continue to invest and see if one has the knowledge of of timing. So time in the market is necessary. So time in the market is a 10-year horizon. But if one understands market structure, if they are, so now we are around the similar level in terms of where we were during the election, the budget 2 years back. 2024 budget day candle that is there, we are at the same level. So that way it is a good point to invest your first tranche, right? And likely we can see a bounce from here going up till 25,000. I don't know, but let's say it's a good risk reward wise. I would allocate my capital with a, let's say a 10% stop loss, right? To see a 20% rise from here. So that way, this is a trade. This is not investment. But somebody who wants to allocate can allocate at this level. But then this war can continue for the next 4 to 5 years. The Ukraine war is still going on, and this war is directly impacting us in terms of our energy security. And the earlier Middle Eastern wars that were there, the Iran-Iraq war, the Afghanistan war, Iraq-Kuwait war, these lasted for years. And
That didn't impacted us more.
It did impact us.
But not at this scale, right?
I don't exactly have the numbers of how it impacted because it was a very long time ago. It was the 70s, but there was a period of no returns in equities in the 70s because of higher oil prices. So I'm 70s Indian markets data is not very handy to me, but it was a very difficult time for equities in general, the 70s, when all these major oil wars were happening. And there is no reason to suggest that this cannot last for a couple of more years. Now it depends. See, it depends a lot upon how the politics has changed. Right? When there was Vietnam War, there was a mass revolution in the US. That led to the governments toppling. So what kind of political activism will happen in the US to rising prices, to what happens in the elections in November, and the way Donald Trump is in terms of the other politicians that has been in history. So it can be a very we are seeing that every day, right? Monday it's a gap up, Tuesday it's a gap down. So that style is different, but it can get over in 1 week's time, it can get over in 1 month's time, and it can go on for decades. At least few years. And whatever damage is getting done to the infra will take years to recover. And whatever alternatives they want to build will take years to do that. So it is a major impediment to India's growth story, Indian markets, etc. So one has to be cautiously looking at those things. But having said that, if you have a 10-year horizon, then this is a good opportunity. And if your horizon is not 10 years, I would say you sit on cash right now and enter the markets when again it breaches all-time high. So you will lose this 15%, 20% rally from year till all-time high. But you can sleep in peace if market goes to 18,000. 20,000 also it can go to 18,000 also. So there are some levels that we have identified. So people say, okay, I am on cash right now. Okay, some of the clients we advised, okay, 26,000 is a good level. Again, the second top was made, so it had a kind of a fake breakout. So whenever there is a fake breakout, the chances of going down are higher, because a lot of people are trapped at that level. So we had a very small fake breakout. So it was a good time to sit on cash right now. So one of my clients is still sitting on full cash. Then he said, I want to deploy. Then we gave him this 4 levels that this is the level what happened with the budget day. We are at that level, so you can deploy some capital. Then there are another levels that we identified, 22,000, 18,000. So if market goes to those level, you hold your cash and you allocate as per that. And if market reverses, if it crosses 26,000 again in the coming year, then you deploy full cash, because it is going to then shoot up. Right? Because it has already tested 26,000 once, came down, and again it is going to go up. Right? So that way one has to be not married to a long-term view that okay, I will do it for next 4 years, 5 years, because that view of the world is going to change very fast. Indian IT, we don't know what is going to be the impact on AI. Because of that, what impact is going to be on the real estate, and so there is a perfect storm that is currently there in the Indian markets, and it can reverse pretty soon, right? The AI bubble can burst, the war can stop the next day, so you can see a reversal. So we as a company or as an investment philosophy are not into forecasting. We are not oracles to know the future. Had I known the future, I would have not done anything in life, right? I just have deployed on my visions, and I would have made millions. So the reason that we don't want to forecast is because nobody knows the future. You can take clues from the current data, from the past trends, and connect the dots, and you can position yourself as per your risk appetite to to prepare yourself for the worst case condition also. That okay, what if market goes to 18,000? What if market goes to 15,000? How much should I be deploying right now if I am forecasting those possibilities? Or we can be reactive. That okay, if market crosses this level, I am going to deploy everything. If it gives a fake breakout, again I am to get out of the market. So one has to be very nimble. So again, the taxation bit, the long-term capital gain, short-term capital gain doesn't allow you to, do these things pretty easily right now. But I think that is the cost of being in the market, that it is better to pay a short-term capital gains rather than seeing your 20% capital, 30% capital get eroded. At a 50% drawdown, you have to perform 100% to go back at the same level. So one, if he's doing simple SIP, do it for the long term. It is tax effective. Everything is there. But if one is going to be worried about where the market is going to be, and if he wants to, be right on the right side of those market movements, then again one has to be nimble. One has to pull the trigger when market is saying enter, when market is saying exit, and one has to pay the tax around it.
Warren Buffett, we know, the greatest investor of our time, it's sitting on around $382 billion in cash. And like what he saw about AI that institutions and retail didn't.
So, Warren Buffett has not invested in any new technologies ever in his life. He did not invest in Apple when it was a very promising companies. A lot of people said that, oh, this is going to be a very big company because of all their an understanding of technology. Warren Buffett invested in Apple very late, but still most of his money that he has made, his net worth, he has made through Apple. So one doesn't need to be the first one to invest in new technology, but once you understand that these technologies are going to be there for long and how they are going to impact us. So now it's a flux, right? Anthropic comes with a model, Chinese come with a model, OpenAI comes with a model. So it's a very fluctuating environment. So I cannot say what is the future of AI going to be. There are people who understand that technology much better, though they are seeing, they are forecasting, they are envisioning things how it can happen. But I think that is not the core skill of Warren Buffett. His core skill is to identify companies with a moat, invest in them at the right price, and hold on to them despite of the market cycles for a longer time frame. So you don't have to really be knowing about the AI tech trends to make money from it. So you can do that, but you don't have to. So that way, Warren Buffett is a systematic investor. I appreciate him, or have praises for him, not because he has made so much money, because he was able to follow the scientific principles. He was able to implement value investing much more like decades earlier before it was published. So 1930s, 1940s is when Benjamin Graham was investing with that methodology. Warren Buffett started doing it in the 50s, I guess. And this that value investing works was scientifically proven in the 70s. So he had been following that method of investing even before that getting discovered, and that is not an easy way of investing. And the second factor, or the second way by which Warren Buffett has made his money is by owning an insurance company. So what an insurance company does is sells you insurance and takes a premium from you, right? And a market parlance to that is option selling. So option selling is nothing but you are selling insurance. That market will not go above 26,000, it will not go below 20,000. So you are selling insurance to people who are fearful or greedy that market will go to that direction. So when you are selling options, the premium that people pay or what people expect the volatility to happen is always less than the actual volatility. So people are always paying higher for insurance, paying higher for options than the actual volatility that happens in the past. So today people are very fearful, right? Our volatility index is at 25, 28 kind of level. So people are expecting that kind of big moves. So when people are expecting that kind of big moves, market will not move that much. It can move, but statistically, the probability of market moving more than what is priced in already is low. So realized volatility is always lower than implied volatility of the options. So that way, that one factor, he collected money from people through insurance premium, invested those investment premium, insurance premium into these companies, and that is how he levered his business, right? So leverage plays a part in that. So the amount, so he gave, let's say, on an absolute basis, let's say a 20% return. But if you lever it up with with insurance premium money, then that returns becomes very high. So that is how he has become the world's richest man. So he has applied three factors essentially. So one is the value factor. When Charlie Munger joined him, they introduced the quality factor, and the structure in which they are investing is a insurance selling factor or a short Vega factor. So the entire returns of Warren Buffett can be explained by use of these factors. So not taking away from him what he has done, because it is very difficult to apply all these factors for nearly half a century he has done that. So that is very difficult. But knowing those things before it got published, using it for decades, is where it has led him. So one should learn from that aspect also, how to systematically invest, how to keep your emotions aside, and how to harness these scientifically proven factors. One should not ignore them.
So, what should be your direction and what should be your guidance for someone who is in his 20s and just starting to invest? So, what would be your point of view on that?
So I would say that mutual funds sahi hai, and mutual fund sahi hai is it has been a very positive thing for the Indian market in terms of educating people, in terms of how to save money in a disciplined manner and how to deploy money in a disciplined manner. But not all mutual funds are sahi, right? So more than 50% of the mutual fund managers underperform their index. So S&P runs a yearly study of the mutual fund industry, of how active mutual fund managers perform with respect to the benchmark. So more than 50% of the managers underperform their benchmark over a 3-year, 5-year, 10-year window. So there are very few managers who are able to give you more returns than Nifty 50, than Nifty 500.
Is that led by, because a lot of mutual fund distributors are biased, okay, they sell particular products only, like thematic and all. So is that a reason, or is that one of the reasons that led to that result?
That is definitely one of the reasons that the distribution network is getting commissions from AMCs directly, and that way they want to sell products that are that people will readily invest into. So it is not entirely, I would say, the distributor's faults or the AMC's fault, but people also demand the same thing, right? I want to invest in a fund which is going to invest into defense, right? It was defense some years back, it was infra a decade back, it can be real estate. So investors also are looking for that kind of mutual funds, and that is the reason AMCs are making those kind of funds. And because of this demand from the customers, because of the television media, so it is like, everybody's at fault, right? So what should a investor do in this situation? So ideally, what investor do in terms of mutual fund is that they look at past performance of mutual funds. So very few mutual funds are able to deliver upon similar returns as their past performance.
Like I have seen some people who only rely on the NAV value, but one should be aware that where it's going and what's the
Yes.
direction, what's the advisor is telling.
Yes. So basically, one should not invest basis 1 year, 2 year, 3 year returns of different funds, because those returns are also mean reverting. So for a person who is starting to invest, one should invest in direct mutual funds of, let's say, indices. So one is a conservative investor, he should invest in Nifty 50 index. One is, if he wants to take exposure to small cap and mid cap, there are index funds around that. So that is the bare minimum level of investment one should do. And index investing in the US is the norm. More people do index investing than active investments in the US than we do in India, because Indian media or the fund houses or distribution network have not educated the clients or the investor based on how they should look at measuring their returns. So that way, people have to understand that many of their funds are underperforming, and why should I pay distributors commission? Why should I pay the higher fees that are charged in active mutual funds if they are going to underperform statistically? Then why should I not go with index funds? So one should read about index investing. Vanguard is the biggest index investment firm started by Boyle. You should read the books about Boyle, that why index investing is the right thing to do. And people have still made some money in Indian markets because our market was maturing. US is a mature market, so there are a lot of possibilities are lower. But India market is maturing fast, and as the S&P reports that are there, active versus passive, so there you are going to see that investing in active funds is not the right thing to do. Then they will say, I don't want to have the 13%, 14% kind of returns that are there in Nifty 50 or Nifty 500 funds. I need to have some additional money.
Outlier results.
That is a fair expectation from the retail clients. That is fine. So to that, then why not rely on smart beta products which were not there 5 years earlier? There was not a momentum fund. There was some value funds. There was not a low volatility fund in India. There is still not a multi-factor fund that encompasses all the factors, right? Quality, low volatility. There is an index, Nifty 500 MQLV index, which has all the 5 ingredients. But there is not an index fund for that. So why not, the AMC should launch that fund. People like us, we are building our products based on that philosophy. So people should invest into smart beta funds. If you look at the performance of Nifty 500 MQLV fund, it has given 17 to 18% return at a volatility lower than your Nifty 50. So it has given you 5% extra at 2% less volatility. And if people are not able to beat Nifty 50, 50, 60, 70% are people of mutual active managers are not able to beat their index, you tell me what is the probability and percentage of active funds beating your multi-factor index. So when you talk about alpha, you have to talk about alpha in terms of these indices. So a person who is doing a 20k SIP, he should look at index funds, he should look at smart beta funds, and he should definitely look at having couple of index funds that mimic a multi-factor index, like one momentum fund, one value fund, one low volatility fund, one quality fund. So that way he can allocate 20% of his capital to these 5 funds and effectively have a multi-factor fund. That way, I think he can sleep peacefully, compound his money, pay low in terms of commission and AMC cost. So I think that is the best way to do. So mutual funds सही है, but factor बेहतर है, is our punchline, you would say. So people should really, read about it, and it's very out in the open, but nobody wants to talk about it because it's a low-cost product. People should go to niftyindices.com. They should go to strategy indices. They can look at all the indices that are there. They can look at all the different AMCs that are offering different products linked to those indexes, and they can see that how they have outperformed. So all this data we are also going to make it easily available on our website, kevalainvest.com, so that it becomes much more easier for people to appreciate how scientifically proven outperformance can be driven with peace of mind.
That also differentiates how Kevala Capital is different from other firms as well. And a misconception is there: mutual fund distributors don't charge upfront, right? Compared with SEBI registered investment advisor. So in their mind, yeah, SIP is going and we don't have to even pay, but that commission rate and all that is all hidden from their point of view. But compared with SEBI registered investment advisor, who charges upfront but gives you the whole transparency, gives the whole unbiased advice. So how should a retail investor know these things?
So this is a good point, and this again has to do with our Indian psychology and mentality. So we like to use free windows, right? Everything free we want to use. So as a society, we don't want to pay anything upfront, and it is very difficult for investors to pay something upfront, and if something is hidden and part of terms and condition, everything, they are, again, it's a psychology that if you ask me and you give me $1,000 from my pocket, I have to give you that money in hand. But if that $1,000 is part of invoice, there is a one star shaped, so nobody gives tip, right? But if tip is included in the bill, half of us don't read also that service charges means tip. So that blind spot is there, and that blind spot is what distributors, the AMCs are using it. But I would say finally it's the retail customers' fault here, or the education has not happened. So and over the decade, we have seen people who said that they want to do direct mutual funds, and they have gone to become distributors. And my view on this would be that it is okay as long as people are systematically investing in SIPs. 1% cost to the distributor, not to the direct fund, is still okay. If the distributor is going to call you saying that, sir, 31st March aa gaya, you do the investment. If he's making that call, if he's doing that, nudging to the customer to maintain his SIP for his 1%, then that is still a service, in my opinion, because of that discipline, he's going to get more. And rather than fighting, what the customer wants to do, it is better to adjust to his preferences. And that is the reason we have seen humongous growth in terms of capital under management through distributors.
A friend of mine asked that institutions like Jane Street, Citadel are there who are high frequency traders, and they have like billions of capital to allocate to perform trades and invest. How should a retail investor beat them?
So, retail as such uh, is not in direct competition with, let's say, a Citadel or a Jane Street. And uh, unfortunately, they had come in direct, contact or directly pitched against each other. So, the way Citadel operates, or the way high frequency firms operate, is that they are looking at micro inefficiency in the market, and through that, they are basically also providing liquidity. So what they are doing is that they are placing buy orders, sell orders at the same time effectively in a fraction of a second. So for human perception, it is the same way. It is the same instant. So whenever a retail is interacting, the kind of liquidity that is seeing, because it is because these HFTs are performing the both buy and sell. So effectively, uh, what Citadel particularly primarily earns through these high frequency strategies is market making basically. So what they are earning is what service they are providing in terms of liquidity. So that is the cost of liquidity that is there. What what was happening with Jane Street was different in the manner that they were basically uh, taking advantage of the structural lacunas of the Indian market. So if you have to explain that, so there is an index, Nifty 50. So Nifty 50 has certain constituents. Reliance is X percent, HDFC is X percent. So the amount of money that is needed to, let's say, move HDFC by 1%, move Reliance by 1%, and effectively that way moving Nifty by 0.5% is very low in comparison to the amount of option writing or the depth of option market that was linked to Nifty. So a 0.5% move in Nifty would cause X amount of loss for in options, let's suppose. But to move that much, ideally in a efficient market, one has to have the same amount of capital to impact that loss. But there were so many people writing options, and there was so much extra liquidity in options than in, let's say, futures of Reliance and HDFC, and futures of Nifty, that there was an opportunity. That opportunity can be because of couple of reasons. Is that there are not many Indian players who are doing the same thing, right? So let's say I understand this strategy. Okay, that to move Reliance, I need X billions of rupees. So Jane Street has it, Citadel has it. So I cannot imagine that some of the Indian people don't have that kind of money. So they can take the opposite trade and trap Jane Street or Citadel in their ways to manipulate. If it is inefficient, they can take the counter trade. So you have to have the, not retail. This is not a retail battle. This is institutional battle. So if institutions is taking that trade, and if you think that that trade is not logical, then one has to take the opposite trade, and that way the inefficiency will get resolved. Now, why would that inefficiency not get resolved? I don't think it is because that, Indian talent or Indian managers or don't have that wherewithal or that intelligence to do it. I would rather say that there has been a slight, non-level playing field when it comes to foreign money and how they operate, and Indian people or Indian HFTs or traders, how they operate. The taxation is different. So something that makes sense for a Mauritius-based firm doesn't make sense for a Delhi-based firm. So that inefficiencies have cropped up over years because of difference in taxation. So one of the like very simplistic examples can be that why is there is so much option volume, and why not so much equity cash volume or futures volume also. That is because you pay STT, lower STT on options, because you are paying STT on the option premium and not on the value of the futures. So taxation wise, it is much easier to do options than futures or cash. That's why people, traders move to that domain. There is difference between taxation of Indian entity versus overseas entity. That's why we are not able to bridge that inefficiency gap. So what they were doing is manipulation that has been cited by SEBI, etc. But the reason that manipulation exists uh, is not because of, in a open capital market, people should be able to do high frequency trading, and if the level playing field is there, then a HFT will do what a Indian HFT will do, what a foreign HFT will do. So my 2 cents on that would be that to make it a level playing field for Indian traders also, and doing that through, let's say, lower taxation. And obviously, we don't want to promote the gambling nature of options for retail. But let's say a qualified institutional investor based out of Delhi, Mumbai, not retail, should have the same tax treatment as a foreign institutional investor, right? So that way, you are allowing the game to be played by the same people, and that way, retail investors eventually they lost. So they would not have lost had there been a solid Indian institution who would have been doing the opposite trade what Jane Street was doing, right? They were manipulating, and they were able to manipulate because there was no other counterparty to stop that manipulation. Now regulator had to come in, because regulator itself didn't allow a Indian entity to perform well in that manner. I don't think it is just that, they had some magical formula by which they could manipulate it. It is not that difficult in terms of how the trade is structured. You buy in the futures, you see the arbitrage of index options versus stock options, and you see what depth is there in options market, and you can make out the maths that how to, how do I trap these many option writers. So it's not rocket science, but some people were able to do it. Other people were not able to catch it or do the counter thing because of some of the impediments that we as a market have implemented. So I may be wrong, but this is my honest opinion about how this has how this has come out, and how retail would have been better protected.
We have covered a lot of things, and thank you for being the guest to the Invexora podcast series. We have learned a lot of things, and you explained in a very curated way. And hopefully, our retail investors and our viewers also got insights from you. So, thank you for
Thanks,
being.
Gaurav, for having me. Hopefully, it helps retail clients and at least gives them a way to think about different things. I may be right or wrong in some aspects, but I just want people to, start giving more thought about it and have a different look to the market. Thanks a lot for giving me that opportunity.